Hello guys. Last time I have gone through a brief introduction of MA process and also uh, what is a merger agreement, what will be typically included in the merger agreement. We also went through a kind of example filing. And last time we stopped right here. Basically, we talk about what is auction deal, what is the one-to-one negotiation deal. When we say private negotiation, right, what we meant is that there's only one bidder there. So it's really the negotiation between one target and one bidder. But auction, that's also private, right? Private to the investor, but public in the sense of because there are multiple bidders involved in the process, right? And let's actually look at two examples. So this example is the deal between IBM and Red Hat. You can see basically you'll be able to quote whether the deal is an auction deal or one-to-one negotiation from the filings. And what are the filings here? The filings are basically the filings that firms or the firms that involving the business combinations, they have to file with SEC. And in this filing or these types of filing, they have to disclose the background of the merger, where they have to detail every single event that happened during the merger negotiation from the beginning to the end, right? And what is the end here? The end is when both parties publicly announce the deal. Huh? So that's why the background of the merger section in these filings, which is typically called definitive merger 14A filing, right? This background merger, they provide a microscope into the specific events that happen during the merger negotiation process that is taking place before the public announcement of the deal. So you can see this is the deal between IBM and the Red Hat, right? So what the initial, which is the initial like first or second paragraph, talking about the kind of fact that Red Hat board directors have been implementing different strategic alternatives in order to enhance the shareholder value, right? So Red Hat is also making acquisitions. And also, since October 2016, the financial advisor has run advice to Red Hat regarding different strategic matters, right? Now, this paragraph basically says that IBM and the Red Hat, they initially has prior partnerships, right? But not related to business combination, but like broadly, it's about commercial partnership. Now, this paragraph in February 2018, this is saying that the CEO of Red Hat and also the CEO of Party A, which is a anonymous different party. So that's a different company, right? And then in that case, the CEO of Party A indicated possible interest in acquiring Red Hat, right? So you can see this is a type of deal that is initiated by third party, right? So not IBM, not Red Hat, but the third party, right? So previously, last time we talked about different ways to initiate a deal. So it could be initiated by the final bidder, final acquirer. It could be initiated by the target. It can also be initiated by third party, right? Which is typically the case here. Now you can go through the rest of the filing, but basically party A is involved in this merger negotiation process. And then moreover, you can see IBM also is involved, right? So later IBM joined the bidding for Red Hat. You can see later Party B, another company, is also involved in the merger negotiation process, right? In particular, they participate in a bidding process, right? And also another company, Party C, also participates in this process, right? So now you can see this is a typical auction deal, right? Because more than one bidder actually are involved in the bidding process, right? So this is a typical auction deal. Another example here is the acquisition between the acquisition of 21st Century Fox and Disney, right? So 21CF, this is a short abbreviation for 21st Century Fox, right? Now you can see this is also a typical auction deal because if you go through this merger filing, not only Disney is involved, but also you can see if you go through this, party A is involved, right? Another company, and also party B, right? And also, yeah, party A and B is involved, right? So you can see that's why this is also an auction deal, right? So that's why we can, in general, we can classify whether a deal is auction and negotiation deal by looking at the background merger section in the merger filings, right? So these are the two topics you can have a look by yourself. Now, we're going to continue to talk about different components in the merger agreement. Another important component is called confidentiality agreement, right? So this is the agreement that is very important in the merger negotiation process because, I mean, what are the target and acquire negotiating for, right? They're negotiating on the price, right? But without knowing the proprietary information, the very secret information of the target firm, there's no way for the acquirer to make a correct judgment of the value of the target. In other words, the acquirer won't be able to make a reasonable offer without knowing the very detailed proprietary information of the target firm. That's why the bidder or the final acquirers they have to sign this confidentiality agreement in order to have access to those very secret information, right? They have to sign an agreement because they are not allowed to disclose this information to other parties, right? Especially in an auction deal, right? Because there are many bidders participating in this bidding process, right? But in order to make the bid, these bidders they have to have access to the financial information or proprietary information of the target. But there's only one final bidder, right? So meaning that there's only one winner there. But the losers there, they have access to the target information, but they are not the final bidder, right? So there are risks that this losing bidder will use those information, right, at the cost of target shareholders, right? So therefore, these confidentiality agreements make sure that the bidders in the merger negotiation process will not take advantage of this proprietary information provided to take action that harm target shareholders. So that's the idea. And so basically, when companies they engage in negotiation, the buyer needs to get access to the non-public information, right? So this is their basis for offer, right? This is the basis where this is the basis based on which the acquirer is going to make an offer, right? And the typical agreement requires the bidder not use the information for any purposes other than the friendly deal at issue, right? So and also they should not make hostile bids, right? So hostile bids means unsolicited bids, right? That is, the target doesn't want the bid, then the acquirer should not make it. And confidentiality agreements define the responsibility of recipients, right? And also the providers. And also they often include a standstill agreement, right? So what is a standstill agreement? That typically limits actions the bidder can take, such as the purchase of the shares, right? So provides a limitation. And the confidential information we are talking about here, it's usually the information about operations of the target, including intellectual property, right? That's the most important one. But also it will be about the deal itself, right? So these are the typical confidential information that we are talking about. And when the buyer is prepared to make an offer, right? So I mean, after they get access to those proprietary information, then they should be prepared to make an offer, right? And if they think that the seller might accept the offer, then the buyer will prepare a term sheet, right? And on the term sheet, the major terms of the deal will be set forth, right? It will be set forth in writing in order to reduce the uncertainty, right? And after the term sheet has been made, or during the process, the acquirer wrote down this term sheet, a great deal of due diligence has to be done afterwards, right? So due diligence means that after the acquirer formulates this term sheet, they still have to conduct a very detailed due diligence of the financial information of the target and also the details about the deal looking forward, right? Especially what are the potential synergy, what are the potential growth opportunity the business combination will bring to the acquirer, right? On this term sheet, it will specify buyer and seller price consideration and contingency, right? And also another document here, further in the process, is called the letter of intent. This letter of intent delineates more of the detailed terms of the agreement, right? And some of these letters will specify the purchase price, and the other letters, they may only define a range of formula. For example, I'm willing to make an offer in the range of $100 to $105 per share, right? So that's a rough range of the purchase price. It might also define various closing conditions, such as providing for the acquirer to have access to various records of the target, right? That is conditional on the acquirer having more information about the target. And this letter of intent can also set forth the initial major deal parameters, such as prices, right? Next, we're gonna talk about the structure of M&A deals, right? There are two main types of different structure of the deal. The first type is called asset deal. The second type is called entity deal. And there are major differences here, right? So the major differences here is that in an asset deal, the buyer doesn't have to accept the target as a liability, right? Doesn't have to accept all the target liability, right? So now you can see there's a divergence in the preferences between buyer and the seller here. The buyer, it is good news for the buyer, right? Because buyer, if you buy something, you don't want to take care of the liability, right? Because if you take care of the liability, that means you have to pay, right? You have to pay off the debt, right? That would be the negative, that would be the burden thing on you, right? But seller, they want more liability to be accepted, right? So if buyer doesn't want to take care of the liability, then the target or the seller have to take care of the liability before they sell the company to the buyer, right? So in an asset deal, the buyer can pick assets it wants as well, right? So for example, I want this factory, I don't want that kind of subsidiary, right? So this kind of thing. So that's why asset deal is a good news for buyer, but bad news for the seller, right? And there are also potential tax benefits from asset deals, right? Because the buyer can pick whatever assets want to include in the final company, right? So there's potential tax benefits. And this tax benefit is called asset basis step-up, right? So these benefits, they can come from the buyer raising the value of the acquired assets to the fair value of the market. All right, so there are different values of the seller's assets, right? It could be the value that are recorded on the seller's balance sheet. It can also be the fair market value, right? So in that case, because the acquirer can do whatever they want with the assets that they acquire, they can also increase the value of the acquired assets to the fair market value, right? Now, if they increase the assets value, that means they will enjoy more depreciation in the future, right? If you buy the assets, they will be depreciated over time. So more depreciation, that potentially means they might be associated with lower taxable income and the taxes paid, right? Because depreciation can serve as tax shields, right? There'll be tax deduction there. That's why there are potential tax benefits. So on the other hand, you can see because buyers, they don't have to accept all the liability and they can pick whatever assets they want. That is why seller, they typically do not want an asset deal, right? They will prefer a whole entity deal. So if it's a whole entity deal, then the buyer has to accept everything of the firm, of the target firm. Right? So that's the idea. In an asset deal, the seller might be left with assets it doesn't want, and also the seller, the target, might be left with liabilities, right? So that's why they prefer power-negative deal. And in an asset deal, the seller might also have to secure third-party consents to the sale of the assets, right? Because many of the assets of the target firm might not just belong to the seller, right? It could be assets from the target's strategic alliances, the target's partnership with other parties, with other companies, right? So in that case, when the seller sells those assets to the buyer, they have to secure third-party consents, right? Who are also owners of these assets, right? So that's the idea. Typically, if you want to do entity deal, there are two kinds of entity deal. It could be a stock transaction, it could be a merger, right? And typically, a stock transaction is usually conducted when there are concentrated ownership in the target. Why? Because like I previously said, as long as you want to do a stock transaction, and typically if it's like the majority of the consideration is stock, then you have to get the approval of all shareholders of the company. And that is very costly and cumbersome process because, I mean, that needs to go through a voting, right? If shareholders do not approve the merger, then you cannot make the merger go through. Right? Now, if the target has concentrated ownership, meaning the target ownership is only in a couple of individuals, like managers or top manager, then that's easy, right? You don't have to have a voting process, right? You can typically just get approval of these guys, and that's easier to get a through, right? And if it's a dispersed ownership in the target, right, meaning that target firm is held by many different shareholders, then in that case, that's a merger, right? You have to do a merger. So in that case, you have to get approved. If it's a stock merger, then you have to get approval of all the shareholders, right? And typically, a stock transaction or stock entity deal here, it's a very quick deal, right? Because in that case, the buyer doesn't have to buy the assets and send a consideration to the target. But the consideration is sent directly to the target shareholder, right? And then they just sell the shares to the buyer. So you can see there's no exchange of assets here. It's just exchange of consideration. So basically, they negotiate for a price, right? Let's say $100 a share, and then 1 million shares. They just pay $100 times 1 million shares, and then you send a consideration to target shareholder, and then target shareholder sell the shares to you. That will be the whole process, right? So the benefits of a stock entity deal are a lot, right? So for example, there are no contractual restriction on the transfer of assets. For example, if the target from the assets, they are together with another company, with a partnership, in that case, there are contractual restriction. But if you do an entity deal, everything is yours. There are no contractual restrictions, right? And then with the stock deal, the assets stay with the entity and remain at the target as opposed to the acquirer's level, right? So that's also a major difference. And also there are no appraisal rights for the shareholder of the target. So we'll talk about appraisal rights in a little bit. Basically, it means that if target shareholders, they are not satisfied, right? If they are not satisfied with the offer price that the acquirer paid, they can go to the Delaware court to ask the court to evaluate the value of the shares they hold. Basically, to evaluate a target company, right? In most cases, the Delaware court, they will say that the actual value of the target is higher than the offer price acquired paid. So in that case, you can see the shareholders who want appraisal rights at a court, they will typically win. And actually, they can profit from the difference between the offer price and the price that is awarded by the Delaware court. So in that case, that would be costly for the MA. All right, so it will make the MA process slower, right? And also it will cost acquired shareholders, right? So that's why the benefits of a stock entity deal is that there are no appraisal rights for the shareholder. right? So that's why if shareholders are not satisfied, right, they cannot go to the court. So in that case, it will be good news for the acquirer because the process is facilitated. Of course, there are also costs of stock entity deal, right? So one of the costs is that the buyer will have to assume certain liabilities, right? And one way to kind of get around this issue is that the buyer, they can have the seller indemnify against the exposure, right? Because I mean the buyer has to take care of the liability, right? But this liability might become the burden, right? So for example, if there are adverse market conditions going on, right? So in that case, it will affect the liability that a buyer has to take, right? So basically, in that case, the buyer can ask the target to indemnify against such exposure, right? So what does indemnity mean, right? Indemnity basically means that it is the contractual obligation of the target firm, in our case here, right, to compensate the loss incurred to the buyer here due to the acts of the indemnitor of any other party, right? Um, for example, the target has a liability, right? And then this liability, the value of this liability will change if the other third party do something. All right. So for example, if the market, let's say this seller has CDS, right? And then all of a sudden the bond market, the stock market goes down, right? The stock market crash, bond market crash, and economic recession are coming, right? So in that case, the value of the liability goes up, right? So in that case, the seller, if they indemnify against this exposure, then the seller has to compensate for the buyer for such losses, right? If the value of the liability goes up, right? Another cost of stock entity deal is that the target shareholders have to approve the deal, right? They have to approve the deal because remember, what I reminded you earlier, right? If it's a stock deal, or especially if the majority of the consideration is stock, then the target shareholder have to approve the deal, right? So that is the costly process stock entity deals have to go through. And the second form is the merger entity deal, right? So this is where the target company has dispersed ownership, right? Not just concentrated in a few shareholders, but dispersed across a number of different shareholders, right? So this is where you typically do a merger entity deal. In a merger, basically what happens is that one company survives and the other ceases to exist. And then this is very common for publicly held corporation, right? Because for public corporation, the ownership is not just in a few people's hands, right? It is usually dispersed across different retail and institutional investors. If it's a merger, then the voting approval of the shareholders, it is needed, right? And in Delaware, if your company is incorporated in Delaware, the voting approval of the shareholder, it is actually required, right? You cannot bypass the shareholders. Next, we talk about the forms of mergers. I mean, there are different forms of merger. A typical form of merger is called forward merger, right? So in the forward merger, the target company or the seller, they are merged directly into the purchaser corporation, to the acquirer, basically. And then the target disappears while the acquirer survives, right? In that case, the target shares are exchanged for cash or a combination of cash and security, right? And then the purchaser or the buyer assumes the target liability, right? That's a merger case, right? That's a forward merger. And the drawbacks of this forward merger, which is very common in a merger acquisition, is that you need the voting approval of the shareholders of both companies, right? And then the other drawback is that the buyer directly assumes all of the target liability, right? So that's why, in that case, the acquirer actually acquires assets are also exposed to the liability risk of the target firm. And in Delaware, typically, forward mergers, this very common form merger, they are treated as asset sales, right? They're treated as if the target, they are selling their assets, right? So target becomes part of the acquired, and acquired survives. Another type of the merger is called forward subsidiary merger. That's also called a forward triangular merger. So what happens is that instead of the target merging directly into the buyer actually creates a subsidiary, right? And the target merges directly into the subsidiary, right? So this is a forward subsidiary merger. And this is the graph that shows the process, right? Basically, the target shareholder, they are acquired shareholders, right? The target company is here, and basically, target company merges into the subsidiary of the acquirer, and acquirer pays the compensation to the target shareholder. The advantage of forward subsidiary merger is that there are no automatic votes required to approve the deal, right? Because the target is merged to the subsidiary of the acquirer. In addition, the purchaser is not exposing assets to the liability of the target, right? Because strictly speaking, it's the subsidiary of the acquired that is buying, that is acquiring the target. And typically, if the buyer issues 20% or more of the stock to finance the deal, then there will be requirement to vote of the purchaser's shareholder, right? So that is typically 20% threshold, right? Finally, there's also a deal called a reverse subsidiary merger, right? So that is the acquired subsidiary pays the target shareholders and then receive the shares in the target in exchange. And then the subsidiary that is formed for the purpose of the merger merges directly to the target, right? So in that case, you can see target corporation survives, right? It's not like in the previous like forward merger and also forward subsidiary merger. In those two cases, the target company actually disappears, right? In all our cases here, the target corporation actually survives and the subsidiary goes out of existence, right? The key advantage of this reverse subsidiary merger is that there are no problems with the non-assignment or non-assignability clauses. Right, so you can Google search these two clauses in greater detail, but basically the idea is that sometimes if you buy target assets, right? For example, if you buy the patents from the target, then originally the patents belong to the target, right? Now you have to like reassign the patents to acquire, right? But sometimes there are difficulty of doing so, right? So in that case, there will be problems of non-assignment, right? But this issue of non-assignment is typically solved if you use this reverse subsidiary merger, because target, it is still a company there, right? It is a still public company there. So there's no issue of non-assignment there. Because sometimes when target disappears, right? Target no longer is a public company, right? If it becomes a subsidiary of the acquired, it is also sometimes not a public company, right? So in that case, there could be non-assignment issues. Now, finally, if everything is negotiated, then both parties will sign a merger agreement, right? And then the merger agreement are prepared by the law firms, right? And then some of the key components in the merger agreement will include the purchase price and also the consideration, right? For example, if it's 100% cash, or half cash, half stock, or it's a stock for stock, 100% stock deal. Right, so an agreement also includes all representation and warranties, right? And these representation and warranty, they were expected to finish before the closing. And also, the agreement will specify the details of closing, the termination clauses, right? So all of these components we will actually talk about in greater detail in later semester. So here, I'm just gonna provide you a brief overview of the components here. So basically, after you have a merger agreement, right, then you have to get a merger approved by the shareholder, in most cases, right? In deals where the bidder is financing the offer using 20% or more than its cash, then shareholder approval is required, right? In NYSE, AMEX, and NASDAQ stock exchange. So this paper by Li Liu and Wu, 2017, find that when bidders issue as much as 20% or more, they actually experience a 4.3% increase in announcement return, right? So this is kind of a, they explain this effect by the disciplinary effect, right? Because if shareholders approve the merger, that means shareholder believe that the merger is in the best interest of the shareholder, right? So that's why investors will also think that this deal is good for shareholder, right? But if it's not approved by the shareholder, it could be that it is out of the private interest, out of the self-interest of the acquirer, right? So it might not be in the best interest of the shareholder. That's why investors might not have a good response. And following the shareholder approval, the merger plan will be submitted to the relevant state official, right? And then the state official will issue a certificate of merger or consolidation. Right? So this is the typical process. So in the merger process, board of directors, like we previously talked about, they have very important duties here. And in the process, they will choose to form a special committee to evaluate the merger proposal. And in this committee, if you have conflict of interest, you should not be members of this committee. Right? And this committee will seek legal counsel to guide it on legal issues. And then, like we just said, they have to make sure that the deal is in the best interest of the shareholder. And other components of the merger agreement is there will be a fairness opinion. Right? Basically, acquire and also target company, they will try to find financial advisors or third-party valuation experts to provide a fairness opinion, right? So which basically says the consideration paid by the acquirer is fair in terms of the financial ratio, in terms of the financial aspects. Right? They will make sure that the fairness, they will make sure that the acquirer is paying a fair price to the target. Right? But I mean, in reality, you can see this is just not very useful, right? Because I mean, if the fairness opinion is really useful, why do we see many firms still overpay for the target? Right? So that's not very, so that's why it's not really kind of useful from the perspective of investors. Voting approval, we have been talking about this, right? So basically, the percentage for shareholder approval, it's 51%. Right? So only when at least 51% of shareholders approve the deal, then the merger will go through. Right? So this is the idea. Now, finally, deal closing. Right? So we also call it deal completion. Right? So what it means is that the closing of the MA also often takes place after the agreement has been reached. Right? Typically 1 to 2 years. And to close the deal, basically, you need approval from the shareholder, right? So this is one of the steps. In addition, regulatory authority has to approve the deal, right? For example, antitrust authority have to approve the deal to make sure that this deal does not create any antitrust concerns, right? And does not harm the shareholder or consumers, right? So that's the idea. And what are the regulators here? They are typically Justice Department or FTC, Federal Trade Commission, right? And basically, we also have different forms of merger right here, right? One is called short form merger, right? So the shareholder approval process is not necessary. It's not like a must, right? So I mean, but like I said, many companies need it, but it's not a must, right? If you have concentrated ownership in the target, you don't need a shareholder approval, like I said, right? In that case, you can do a stock entity deal. So this is what I just said. And a short form merger in that case can occur when the shareholders of the insiders are beyond a certain threshold, right? For example, 90%. So very concentrated in a group of insiders. In that case, you don't actually need the shareholder approval, right? A short-term merger may actually follow a tender offer as a second step transaction. Right? So the reason is that shareholders who did not tender the shares to the bidder who actually acquired substantially all of the target shares may be frozen out of their positions. So The idea is that first of all, the bidder buys all the shares in the buy most of the shares in the target, right? Then, I mean, if the bidder buys most of the shares in the target firm, then they become actually the insiders, right? Then they become insiders. So in that case, most of the shares of the target firm are concentrated in the bidder who are insiders now, right? Now they can do a short form merger, right? And then in that case, if the shareholders, if the remaining minority shareholders do not tender their shares, in other words, do not sell their shares to the bidder, they could be frozen out of the position. So this slide typically explains what is freezing out, right? So what does freeze out mean, right? This typically means that when a majority, typically 51%, approves the deal or above, right? Minority shareholders, they're required to sell the shares to the controlling shareholder, right? And this majority approval requirement is designed to prevent this hold out problem. So it could be that the minority shareholder, they're not satisfied with the price that acquired paid. So that's why they don't agree to the merger. In that case, they hold up the completion of the transaction, right? So unless they receive compensation over or above the acquisition stock price, right? So this is the majority vote requirement. But on the other hand, these minority shareholders, they also have the appraisal rights, right? So like I just mentioned. Basically, those minority shareholders who do not think that the price that acquired pays is adequate, they can ask a court to determine the value of their shares and to order that they be paid this value in cash, right? So this is what the minority shareholder can do. And they have 120 days to file suit. And in kind of recent years, this becomes one of the strategies the hedge funds pursue in order to make profits, right? This legal appraisal system allows the hedge funds that own shares to pursue the higher value, right? For example, a client offers the price $80 per share, but the hedge fund doesn't think the 80% is adequate for the shares they own, right? They can ask for $90 per share, right? In that case, the plaintiffs in these matters will forego the payment by the bidder, right? They have to sacrifice that. And also, I mean, they have to forego this when they seek the higher appraisal value, right? And also the law allows them to receive interest on the amount they are ultimately awarded, right? For example, they sue the company on court in January 1st, right? And then they win the case in December 31st, right? This 1 year interest is also awarded to the hedge fund, to the plaintiff, right? And then the interest rate is actually quite handsome, right? Interest rate now is like 5% plus the federal discount, right? So I mean, imagine you have like 1 million holdings in a public company, and then you earn 5% plus federal discount rate. So typically, altogether, it will be like 7 to 8%, right? That's a pretty handsome, riskless return, right? If you are hedge fund and pursue this appraisal arbitrage strategy, right? Now, finally, before we move on to talk about historical trends on merger, I will teach you one kind of way to evaluate the market reactions to merger acquisition, right? Because the most important criteria for saying whether the merger is good or not, right, or whether the merger is welcomed by the shareholder, welcomed by the investor or not, is to look at the market reaction, right? Typically, we examine the market reactions around the announcement date of a deal to evaluate the quality of the deal, right? And then the general econometric or general statistical approach starts with a proxy for what the stock return would have been in the absence of the merger, right? For example, if there's no merger announcement today, what will be the normal return on these days, right? And then the difference will be the investors' reaction to the merger, of course, and also that measures the quality of the deal. Right? And this difference is called the abnormal return due to the event, right? And then it is estimated as the difference between the stock's actual return and the benchmark, right? And the benchmark return here is usually calculated by using this capital asset pricing model. Right? So because we are not a corporate finance class, so I don't want to go into details of this model, right? But what you need to remember is that this model tells you there's a relationship between the risk premium of an individual stock and the market risk premium, right? So this is typically the idea, right? And in most cases, we assume this alpha is zero, right? The alpha is zero. So you just estimate risk premium equaling beta times market risk premium. That will be it, right? And after you estimate this model for individual company, right? Now you can use the market risk premium in the like, let's say around the announcement date of the deal to calculate the expected risk premium, right? And then if you get an expected risk premium, you then can calculate the expected return for the company around the announcement dates of the deal, right? So then you can calculate the abnormal return equaling actual return minus expected return, right? But so what is risk premium here? This is typically return, the actual return minus the risk-free rate, right? So you don't have to know what is risk-free rate. It's basically the return you're gonna get by taking no risk, by buying a treasury bill, for example, right? The return on buying a treasury bill, right? Taking no risk, right? But typically in reality, risk-free rate is almost zero. So you can just think that risk premium is just the actual return, right? That won't affect your calculation a lot. And basically, we measure the impact of an event. The event here is a merger acquisition announcement, right? By estimating the abnormal return on a stock at the moment information about this merger acquisition becomes known to the market, right? So this is typically when the public companies, they announce that there will be a merger acquisition coming up, right? And one concern that complicates this approach, right? This approach is called event study, right? It studies the impact of an event and basically attributes the market reaction to the event to the value of the event, right? Basically, one concern is that there could be leakage of information, right? For example, 3 months before the public announcement of the merger, before the public merger, there could be leakage of information, right? Maybe insiders, or investment bankers, they already released the information on the social media, right? Or leaked information to the social media. So lots of investors, they already know it, right? So in that case, then any abnormal return on the announcement date, it could be a poor indicator, right? For example, 1 day before the announcement, there could be already, investors already know it, right? So that's why a better indicator here could be a cumulative abnormal return, right? It could be like in the -1 to +1 window. So 1 day before till 1 day after the merger announcement to mitigate this leakage problem right before the merger announcement, right? If you're worried about leakage, like in more days before the announcement, like 5 days, 10 days, you can also calculate the 10-day cumulative abnormal return, right? Which starts from 10 days before the merger to 10 days after the merger, right? We calculate this cumulative abnormal return. It is simply the sum of all abnormal returns over the time period, right? And this cumulative abnormal return, the CAR, captures the total firm-specific stock movement for the entire period when the market is responding to this new information of the merger announcement, right? And basically, when we look at the impact of merger attempts on the stock prices of the target firm or the acquired firm, right? The cumulative abnormal returns of each firm will be calculated, and also we evaluate the statistical significance and the magnitude of the abnormal return, right? And this will indicate the impact of the merger on the stock market, on the shareholder, on the investors. And the typical event window here is to examine here is -1 and +1, right? And this is the window around the merger announcement dates, right? In that case, acquire, when we look at target car and also acquire car, right? Typically, the target cumulative annual return typically reflects how much acquire pays to the target shareholder, right? Because most of the deals, there will be takeover premium, right? Meaning that in most of the cases, acquire will pay higher than the target prevailing stock prices, right? So in that case, target cumulative annual return will typically be positive. And the average, it's about 10 to 20%, right? So that's like takeover premium reflected in the market reaction. But for the acquirer, that's a good signal of the quality of the deal, right? So in most cases, actually, in merger acquisition, the average acquired car it's negative. So even if the magnitude is not so large, but typically the acquired car is negative, right? So now the specific steps here is that first of all, we need to find the stock prices of firm in the normal period. So remember, we need to first estimate the relationship between a company's return and the market return, right? After we estimate this model, we have the relationship, right? And then after we have this relationship between the market return and also individual return, we can calculate the expected return in the specific 3 days around the deal announcement, right? Now, typically, when we try to estimate the CAPM model or the relationship between the return and the market return, we use regression analysis, which I will tell you in a little bit. And basically, after we estimate this model, we can use the daily market returns in the -1 +1 window, right? You can have -3 +3. It's just a matter of the window that you want to investigate. You can use the daily market returns to calculate the expected return, right? Then we calculate the actual returns in this window, right? And then the difference is the difference between actual return and the expected return is the daily abnormal return. And then finally, you calculate the cumulative abnormal return by summing up the daily abnormal returns in the 3-day window, for example, right? This is how you calculate. So now, before I go to one example to explain how to do it, I'm gonna briefly introduce you the regression analysis here. The basic idea of regression analysis is that we use data to identify relationships among variables and then use those relationships to make predictions, right? In our example here, we estimate the relationship between individual stock return and the market return. And then we use this relationship to predict the expected return in the 3-day window of the merger public announcement, right? And regression analysis will describe the relationship between the two variables, right? Like the examples. So one motivation is that suppose you want to predict the selling prices of houses in the region, right? But intuitively, in order to predict the selling price of houses in the region, we need to compare the houses for which we need a predicted selling prices, right? With those houses that we know the price, right? Of course, and also we know they are in the same area. We know that they are similarly large, and also they have the same housing style, and also their location is similar, right? So only when we have those information, we can predict the selling price of the houses, right? Because obviously sizes affect the housing prices. Styles of the houses also affect the selling prices, right? But in reality, it is difficult to find two houses that share the same exact characteristics, right? Same location, same size, same style, same other condition. It's very difficult to find. Right? In that case, the alternative approach is to consider the factors that affect the prices of the houses, and then we determine the relationship between the housing price and all these list of factors. Right? So, for example, the average value per square feet of a new house is $40, and the average lot sells for $20,000, right? So in that case, the predicted selling price of the house of size X, right? So because 40 per square feet, right? So 40 times X plus 20,000, right? That will be the predicted selling price, right? Because we cannot find houses of similar sizes of the houses that we are looking for their prices, right? And then if you have a house of 2,000 square feet, then we can use this relationship to calculate the predicted price. Right? So this is the idea. That is, we typically use historical data to estimate the relationship between the two variables, right? And after we estimate relationship, we use this model to predict the expected housing prices or expected return, right? So this is what we do. So if we want to predict something, the variable is called dependent variable. If the variables, the factors that we think might affect the dependent variables, right? For example, market return can affect individual stock return, right? Housing sizes can affect the housing prices, right? So these factors are called independent variables. It could be one factor or multiple factors, right? If you want to do regression analysis. And then the interpretation, if you write down this model, right? So y equals beta 0 plus beta 1x, right? So the interpretation of this model, and this is expected y, right? Equals beta 0 plus beta 1 times x, right? Basically, the idea is that when x, or in other words, in our example, it's the house prices, right? When x is fixed at the level x, then we assume that the average of y, it will be linear around the level x. Right here, in our model, beta 0 is the intercept, right? In other words, it's a constant. And then beta 1 is the incremental change in y per unit of change in x. In other words, it's the sensitivity of y to x, right? And beta 0 and beta 1, we all estimate them from sample data, historical data. Right? And basically, the estimation, the estimation methodology we use here is we use historical data, right? And we basically measure, because, I mean, if we want to estimate a relationship between y and x, right? It could be many, many kinds of relationship, right? But how do we say that one relationship is better than the other? One model is better than the other, right? One criteria is that the model is more accurate, right? In other words, the predicted dependent variable has smaller deviation from the actual dependent variable. In other words, the predicted selling prices is very close to the actual selling prices, right? Only by saying, only that way we can say the model is good, the model is accurate, right? So basically we will pick the values of these two estimates, of these coefficients. And these coefficients will minimize the sum of the squares of the residuals, right? So what that means is that basically the sum of the squared deviations of the predicted selling prices, for example, with the actual selling prices. That's the idea, to basically minimize the errors of model, errors of the forecasting by the model. Right? So this is the way to evaluate whether a model is good or not. Now I'm gonna show you how to do this regression analysis, or how to calculate the cumulative abnormal return for one deal. Right? Later you will be asked to do on yourself, but I will show you how to do it now. Basically, all you need is Excel. Right? As long as you have Excel, you can easily calculate the market reaction to the deal. Right? This example here asks you to calculate the cumulative abnormal return around the -1 and +1 window of the deal announcement, right? This deal is AT&T and Time Warner, right? And basically, the deal was announced on October 22nd, 2016. But the problem is that the deal, the deal announcement day is a Saturday, right? So in that case, we use October 24th, which is the next working day, which is the Monday after this announcement day, Saturday, right? So I will show you in this Excel here. So let me adjust. All right, now you can see the screen here, right? So the first tab, this is the AT&T stock prices every day, right? From January 2nd, 2015 to the December 31st, 2016. Right? So this is all the stock prices of AT&T. And also I already calculated the return for you, right? Daily return of all these days, right? And this is the risk-free rate, right? You can see from the data, it is almost zero for every day, right? And this is the market risk premium, right? Which is the market return minus risk-free rate, right? Because we know that risk-free rate, it is almost always zero. So this, you can think about that as the market return. Right? Now we need to have a period of data that we can use to estimate the relationship between the AT&T stock price and AT&T stock return and the market return. Right? Remember, we need to pick a period of stock returns that is not contaminated by the merger announcement, right? Because we don't want to pick a period that is contaminated by the merger announcement. In that case, the expected return from the model will be biased, right? So in that case, typically we pick minus 300 to minus 40 before the deal announcement, which is 300 days before the announcement. This is the 300 days before the announcement. This is, and also normal period starts from here, right? Until 40 days before the deal announcement, right? This is normal period end, right? So now in the second tab, I have copy paste all the data here, right? That is from the 300 days before the announcement to the 40 days before the deal announcement. Right? So this is the period of data. This is the data we need to use to estimate the relationship between AT&T's stock return and the market return. So now I'm going to teach you how to do this regression analysis in Excel. So what you do is that you click File here, and then you click More. Now you click Options. Click Options here. If you click Options, there will be load down, right? So this is loadings. Now in the loadings, you will find this is called Analytical Two-Pack. This is called Analytical Two-Pack VBA. Right? Pick any one of them. Right? And then choose Go to, right? And then choose these two, right? Analytical Two-Pack and Analytical Two-Pack VBA. And click Confirm. Now after you do this, after a while, let's wait. So now after a while, you will see this is data, right? There will be a data analysis tab appearing here. Right? Click this data analysis tab. Right? And then choose regression. This is called regression. Right? Now input Y value and X value here. Y value and X value. And remember to suppress constant to zero. So that means make constant to zero. Right? Remember to choose this one. Then input your Y here and X here. Right? For the example here, so after you choose all these things, there will be output up here, right? You can choose the output in another spreadsheet or just in this spreadsheet, right? Now you can see this is the output of the regression analysis, right? And this is the X variable, the independent variable, right? So this basically says the coefficient on the market risk premium, right? The independent variable here is 0.53. So that is the beta here is 0.53. Right, so that essentially means we have a relationship between individual stock return, right? Individual stock return and market return, right? Which is individual risk return or individual risk premium equals 0.53 times market risk premium or market return. Right? Now, after we get this model, we can calculate the expected return on the announcement date. The announcement date is October 24th, right? Let's find October 24th. Back to this tab, right? This is announcement day, October 24th, right? October 21st will be the -1 date. So remember -1 and +1 day, this is a trading day, right? So 25th, this is the +1 day, 1 day after the merger announcement, right? Now this announcement date, right? So this is the market risk premium, right? Now we first calculate the expected return. So how do we calculate expected return? That will be 0.53 times the market risk premium, which is this one here, plus the risk-free rate, right? Remember what is risk premium? Risk premium is return minus risk-free rate. Therefore, return equals risk premium plus risk-free rate, right? So this will be the expected return of these 3 days, right? Now we also have the actual return. Actual return is this one here, right? Now we calculate the difference as the actual return minus the expected return. So we have the 3-day abnormal return, daily abnormal return. Then we sum them up, we get the cumulative abnormal return, which is minus 0.05, right? So that means AT&T, the car of AT&T around the deal announcement is minus 5%, 5.2%. So that seems not a good deal for AT&T, right? Now for Time Warner, you can do the same thing, right? First of all, use the same method. We can determine the normal period start date, which is 300 days before the deal announcement, and 40 days before the deal announcement. Right? This is the normal period end, right? So in this fourth tab, I have showed you the regression output to estimate the relationship between the individual stock return of Time Warner and also the market risk premium. So let's see where are the regression output. Right, it's here. So the coefficient here is 0.9999, right? So basically the beta is 1. So in that case, individual stock return of Time Warner equals market return, basically, right? So now use the same method, we calculate the expected return. Here, this is expected return. And this is the abnormal return equaling actual return, this one here, minus the expected return. You get abnormal return, right? Then the sum of all these abnormal return, we get cumulative abnormal return, right? Which is like 5.14%, right? So that seems a good deal for Time Warner, right? But not a good deal for AT&T, so which typically happens in almost every deal of merger acquisition. So I'll finish this example, right? So you can play on your own, right? Just open your spreadsheet and follow the steps that I have told you. So now let's take a break, then we continue to finish the discussion of merger waves. Okay, finally, I'm gonna briefly talk about merger history, right? So historically, what are the merger waves, right? Merger waves typically mean that there's a cyclical activity of merger acquisition. Basically, in the merger wave periods, there will be high levels of mergers, followed by periods of fewer deals, right? There are 6 merger waves historically. The first wave is like in the late 80s, right? Also the second wave, starting from 1916, third wave starting from 1965, fourth wave starting from 1984, fifth wave starting from 1992, and the sixth wave starting from 2004, right? So before we go to every single wave, the general question is what causes merger waves, right? What explains the historically the kind of high levels of merger activity in one particular period, right? However, 2005, this paper provides a very comprehensive description. Basically, merger waves, they tend to be caused by a combination of factors, right? These combination of factors include economic, regulatory, and technological shocks, right? So the economic shock comes in the form of economic expansion, right? That motivates companies to expand to meet a growing aggregate demand, right? For example, when the economy is booming, there will be more merger waves, right? Because when economy is booming, that means aggregate demand goes up, right? And in order to meet aggregate demand, you have to grow. The company have to grow. But to rapidly grow, because if you do internal growth, that will be slower, right? If you buy a company, that will be easier, right? For example, it might take 10 years to develop a technology on your own, but it might just take a year to buy another company that has that technology. Because that's why merger acquisition is a quick way to grow and a quick way to meet a rapidly growing aggregate demand. Right? And regulatory shocks basically occur through the elimination of regulatory barriers. Right? If you have the elimination of regulatory barriers, uh, that will promote the corporate combinations, right? Because the regulatory barriers of industry actually they in many cases prevent the corporate combination. Right? For example, if a company is very difficult to enter one industry, right? How do you kind of acquire the other company, right? So the regulatory shocks here basically include the change, for example, include the changes in the US banking laws that prevented the banks from crossing state lines or entering other industry. Right? This is the entry barrier that's set up by the banking laws. Right? So if you cannot enter other industry, if you cannot cross the state line, then of course you cannot buy another bank in another state, right? Because this is considered a formal entry, right? So some examples of the deregulatory events, right? Historically, the banking industry is very highly regulated, right? In 1980s, especially in 1985, and also in early 1990s, right? This is when there's banking deregulation going on. And this deregulation allows interstate banking, particularly in California. So what that means that if you are the bank in California, you can actually enter other states, right? And if you are in other states, you can also enter California, right? For example, if you are JP Morgan Chase in New York, right? You can enter California by establishing a JP Morgan Chase branch, San Francisco, for example, in California, right? This is allowed in the deregulation that is approved in 1985, right? So you can see if you allow this, this drives the merger acquisition activity, right? For example, one way I can enter California if I'm a New York bank is that I acquire a regional bank in California, right? For example, JP Morgan Chase acquire a regional bank in California and then change the name to JP Morgan Chase, right? That's how JP Morgan Chase enter the California. Another example of deregulatory events is the Telecommunications Act by 1996, right? Basically, it's the same idea. It opens the markets to competition by removing regulatory barriers to entry, right? So firms can now acquire telecommunication companies to enter into this industry, right? So that's the idea. Finally, technology shocks, they can bring about dramatic changes in existing industry and also create new ones, right? So this is the technological shock. And this paper by Harvard 2005, he looked at 35 industry waves, right? And he also found that capital liquidity is also a necessary condition for the wave to take hold. So the idea is that in order to buy another firm, you need to raise capital, right? If the capital liquidity is high, that means you can sell the assets and raise the capital quite easily. That's also a catalyst for a merger wave, right? There are also other researchers who attribute merger wave to other factors. For example, misvaluation or market timing. Right? For example, firms acquire other companies when the valuation is high. Right? So this is one of the motives of many companies that are in internet bubbles, right? Because the internet bubble drives the valuation of the high-tech company to a very high level, right? And this will enable them to acquire or to buy other smaller companies in a cheaper way, right? Because I mean, at the end of the day, the valuation is going to go to the fundamental, right? So therefore, they might take advantage of the high valuation periods to buy other firms, right? But it turns out that Harvard find that it's not the main cause of the wave, but they could be correlated. It could be a cause in specific fields. for example, in 2000, right? So this could be a reason there. And another paper by Rowe and Storotis find that corporate waves seem to be begin with new issue waves, and first start with seasonal offering and then initial public offering, and then followed by store finance merger acquisition and later repurchase waves. Right? So this is consistent with the intuition, right? Because in order to buy another company, right, using the stock, right, you will need to issue stock, right? If you think that the current amount of shares are not enough, right? And it could start with season equity offer, right? Meaning that you can issue stocks that the mature firm can, the already public firm, they can issue shares to finance the deals, right? And then there are many, many private firms, right? They also want to acquire other companies, right? So in that case, they will go on IPO to raise capital and then pursue stock financed and merger acquisition to use the stocks that they raise to buy other companies, right? Now, after they pursue transactions that they feel that will bring them growth opportunity, right? Now in that case, growth opportunity might dissipate over time. Now they don't have more growth opportunity, right? They don't have good targets to purchase. In that case, they will engage in repurchases, right? Repurchases is an action that can potentially increase shareholder value, right? So this is the kind of sequence of events that happen in the merger waves. Now let's look at each of the waves. I'm gonna quickly go through the first two waves because they are very early in the history and also not so relevant for the modern waves. Basically, the first wave, the theme there is merging for monopoly, right? Basically, there are many, many horizontal mergers, meaning the competitors, they compete together, right? And then the consequence is that there are many monopolist market structure. And actually, the merger wave created many large monopoly who actually still exist nowadays, right? For example, DuPont, for example, General Electric, right? These monopolies still exist today. And then you can see, because in the first wave that there are many monopolies being created, at that time there were no regulations that address the antitrust issues, right? In those horizontal mergers, right? Regulators, they do not disapprove a merger if that creates any anti-competitive concern, if that creates monopoly, right? Now, because there are many, many monopolies created in the first wave, in the second wave that started in 1916, regulators began to pay attention to this issue, right? So in that case, during the second merger wave, several industries, they were consolidated, right? But not creating monopoly, right? The theme of the second merger wave is merging for oligopoly, right? Which is a more competitive form of monopoly. And at the same time, post-World War I, economic boom provided much investment capital, right? And the reason why the theme of the merger wave is merging from oligopoly is that there's more effective antitrust enforcement, right? Clayton-Sherman's acts were passed during this merger wave, right? To prevent what happened in the first merger wave, that is, industry becomes highly concentrated. Basically, the Clayton and the Sherman's Act actually established the foundation, right, for even today's antitrust practice, right? So like I said previously, right, when you announce the deal, you have to submit it to FTC and the Department of Justice for regulatory approval, right? They will review the antitrust issues in the merger, right, and see whether they disapprove or approve the merger. So when they review the merger, they typically employ the Herfindahl-Hirschman index to test for market concentration. Right? So we will talk about this for example when we talk about these antitrust issues later. And actually now, I mean, in recent years, this antitrust enforcement has beginning to kind of have more and more power. For example, Staples and Office Depot deal, right? This is a deal between two competitors in the office supply, right? So this is a horizontal deal. The deal was rejected based on antitrust concerns. Right? And the third wave began in 1965. And the feature of this wave is that they have historically high level of merger activity. And also, I mean, economic shocks, right, is the main reason, right? There's a booming economy at our time, right? And the main feature of the merger wave is that this is a conglomerate merger wave, right? Meaning that it's not like firms in the same industry, firms who are competitors, they merge. It's that firms enter into other industry, other irrelevant industry, by acquiring other irrelevant firms, right? 80% of the mergers during this period are conglomerate mergers, right? And basically, conglomerates in this period conduct a large percentage of their business activity in different industries. Right? For example, General Electric conducted many acquisitions in this period, right? And become a conglomerate. And basically, the first merger wave resulted in dramatic increase in the industry competition, right? But in this third wave, there's not a dramatic increase in the concentration because this is a conglomerate wave, right? The industry does not become concentrated. It's just that firms began to acquire other firms in other industries. Right? So there are papers that examine the shareholder wealth effects of the conglomerate wave, right? Basically, this paper by surveys find that over this period, the average number of business segments increased from 1.74 to 2.6. Right? And also, the more important finding here is that diversified firms, they were valued at a discount. Now, of course, this discount dissipates over time, but they still find there's a discount, meaning that diversified firms, they actually receive lower valuation, right, compared to other firms. The one possible explanation for this is that diversified firms or conglomerate mergers, they're sometimes driven by the private benefits of managers. Right? For example, managers want to build a bigger and a bigger firm so that they can receive higher and higher compensation. Right? Because usually bigger firms means managers have to manage more and then they're going to receive higher compensation. Right? So that's one of the explanations. The other incentive to merge here in the third wave is driven by this price earnings ratio game, right? PE game. Right? Basically, the idea is that because in the third merger wave, there's a booming stock market prices, right? And then this booming stock market provide equity financing for many of the conglomerate takeovers, right? And basically, conglomerate firms, they use this acquisition method to actually increase the earnings per share, okay? Right? And this is also due to that there are high stock values, right? And then this high stock value drive the third merger wave. Now we're gonna look at how this game works, right? So how do acquirers use the acquisitions to increase PE ratio? So suppose that there are two firms. The larger firm has a PE ratio of 25 to 1. The annual earnings is 1 million. There are 1 million shares outstanding, right? And each share is $25. There's another firm, which is Target Firm, has a lower PE ratio of 10, and annual earnings is 100,000. There are 100,000 shares outstanding, right? And then the stock is $10 per share. Right? Now, the acquirer is going to use a stock-for-stock transaction, stock-to-stock consideration. So meaning that it's going to make a stock offer where one share of the larger firm, which is worth $25, is offered for 2 shares of the smaller firm. Right? So there's a $5 premium for each of the acquired stock being offered. Right? 2 shares of the smaller firm is only worth $20. Right? 1 share of the bigger firm is worth $25. Right? So the larger firm also issued 50,000 shares to finance the purchase. Right? So, and then we will show that acquisition causes the EPS of the higher firm to rise, or causes the acquired firm's PE ratio to rise, right? So basically, the EPS of the higher PE firm has gone from $1 that's previously, right, to 1.05, right? Because earnings, what are the earnings? Earnings is acquired earnings, 100 million, right? And then if they buy the target, right, they have additional 1 million. Right? So this is the new, oh sorry, this is the EPS, right? So EPS, earnings per share, right? So that because they have more shares, right? This is the denominator, 105 shares, right? Also they have more earnings, right? This all more, why they have more earnings? Because previously it's only the acquire, right? Now they have acquire and the target, right? So that's why you have what originally acquired is 1 million, right? The target is 100,000, right? Then the total earnings now is 1 million plus 100,000, right? So that's the idea. So now if you recalculate the EPS, it's gonna be 1.05, right? Now the key assumption here is that if investors believe that the PE ratio it is still the same after the merger, now the stock price is gonna increase, right? But if the P ratio stays the same as N is 25, right? Then the new price will be 25 times this new EPS, right? Which will be 26.25, right? So this is why the P ratio goes up after acquisition. But the key assumption here is that investors they keep on using the same P ratio to value the firm that has finished the acquisition. And of course, this process will end after if the market doesn't apply the same P ratio, right? So this is also like one of the important features of the third wave, which is the high stock valuation keeps going on, so that the investors keep on thinking that the high P ratio is going forever, right? But of course, there's no. I mean, every good story has an end, right? In 1968, the market goes down, right? And this company faced the selling pressure on the stock prices, and there are various legal changes that were implemented to limit the use of convertible debt to finance acquisition, right? And also, the buyers, they often paid for the diverse company they purchased, right? And then performed poorly, right? So this is the decline of the third merger wave. Now, the fourth merger wave, there's also another feature, right? This another feature was actually started in 1970s, right? In the 1970s, the takeovers, the main feature of these takeovers are that they are very hostile, right? They are very hostile in the sense of there is very strong confrontation between the acquirer and the target, right? Then so what does it mean to say hostile, right? The hostility is that, for example, the acquirer may directly make an offer to target shareholders without talking to the target management. That is one hostility, right? The hostility also reflected in the resistance of target, right? The target may adopt anti-takeover defenses against the takeover attempt by the acquirer, right? Which we will go and look at the details of the anti-takeover defenses in the next topic. But this is what hostility means, right? Even more hostile tactics include that maybe the target will actually sue the acquirer in the court, right? And this is also the feature of the fourth wave, which started from 1984 to 1989, right? So there is a significant role of hostile mergers, right? Whether takeovers are considered friendly or hostile is determined by the reaction of the target. So if the board approves the takeover, it's friendly. If the board doesn't like the merger, it will be hostile. Right? So this graph shows the net merger and acquisition announcements from 1970 to 2016, right? You can find this fourth wave, right, from 1984, which is typically here. And the fourth merger wave, the other feature is that the target size becomes bigger and also more prominent. And some of the nation's largest company become the targets of the acquisition, right? And that is also why the fourth merger wave was called the mega merger, right? Because it involved many bigger firms being taken over, right? So you can look at the largest acquisition, right? You can look at the target. They are actually quite large firms, right? Those big oil firms, right? And then you can look at how much is paid, right? many are on the level of like 25 billion, right? That's a lot. That's a very big acquisition. And because we have hostile takeovers, right? There's also the emergence of corporate raiders, right? Basically, what is corporate raider? The corporate raider is basically to profit from takeover attempts, right? It doesn't matter whether the takeover materializes, right? The important thing is the corporate raider profits from the takeover attempts, right? Because we all know that when there is a takeover attempt, the target stock price will increase, right? So this will bring profits to the corporate raider. So how they do is that they will try to acquire stakes in a target firm beforehand, right? Basically, when a target goes into play, the stocks tend to be concentrated in the hands of arbitrageurs or raiders, right? And then the raiders will sell to the highest bidder later, right? So this process often results in the company eventually being taken over, right? So you can see this is how the corporate raiders make profits. Right? Also, the feature of this wave is that there's aggressive role of investment bankers, right? So basically, investment bankers they earn a lot from this risk-free advisory fees, right? And partially to help finance the takeover. In this period, there's also the development and the growth of the junk bond markets, because in this period, many junk bond is very heavily used to finance takeovers. Right? So we'll talk about this later when we talk about the junk bond markets. And meanwhile, there's more aggressive use of the debt, right? So, and this is the time where leverage buyout first become very popular. And in those LBOs, debts are used to take public companies private, right? And they're heavily used to MBOs, right? Management buyouts. Also, another feature is international takeovers, right? For example, the 1987 acquisition of Standard Oil of Ohio by British Petroleum, right? And this is the motivation for international takeover or cross-border merger is motivated by, in this period, by non-US companies seeking to expand into larger and more stable US market. Another consideration here is that during this period, during this 1990s, the US dollar kept on depreciating, right, against other currencies, right? So that's why the falling dollar in the 1990s also attracted foreign bidders, right? So this is another feature. Finally, role of deregulation, right? Deregulation also play a very important role here. This Michel and Moher in 1996, they have a sample of 1,064 MAs over this period, over 1982 to 1989, right? What they found is that in those industries that underwent significant federal deregulation, right, there's a very active merger acquisition, right? The deregulation is a causal factor for the merger acquisition, right? So this we already talk about when we talk about merger wave in general. And of course, the fourth merger wave ended in 1980, right? Because the economic expansion ended. Now the fifth wave, we might be familiar with this one, right? Because this is driven by internet bubble. Right? And during the 1990s, the U.S. economy entered into the longest post-war expansion. Right? So again, you can see economic expansion is very powerful factor for driving the merger wave. Right? And then the companies reacted to the increasing aggregate demand by pursuing M&A. Right? And then in this period, there were fewer hostile deals and more strategic mergers occurred. And then you can also see the valuation, stock market valuation, right? S&P 500 index during this period. It is increasing this period. Right? So initially, the transaction in 1990s, they were actually quite kind of rational, right? For example, the acquisition between Miramax and Disney, right? And many of these acquisitions were financed through the increased use of equity, which resulted in less heavily leveraged combination. And the initial transaction in this period actually emphasized this strategy. basically the acquisition of Miramax by Disney is actually driven by strategy, right? Because these two are horizontal competitors. And basically, there's also a feature of industry concentration during the fifth wave, right? In this fifth merger wave, the banking and the finance and the communications and broadcasting accounted for 26% of the US deals, right? They account for a very large deal. And the continued impact of deregulation and consolidation of the banking industry, and also the deregulation in telecommunication industry, as well as the internet-related businesses, right? So in the internet-related businesses, internet was first invented, right? So that drives the technology development in this internet-related industry, like computer, like software, like business services, right? So the deregulation in this period was called Rego-Neo Interstate Banking and Branching Efficiency Act, right? That was actually a follow-up in the deregulation efforts in 1980s, right? Remember what I just talked about, right? So the idea is that in 1980s, all these deregulation happened on a state level, but this one is a federal level regulation that unified the deregulation efforts by the states, basically allowing banks to enter other states, right? So that's why it's a deregulation. And also Telecommunications Act, right? So this one I already talked about. It's also it was also designed to reduce the entry barrier in the telecommunication industry. And another feature of the fifth merger wave is that there have been acquisitions called a roll-up acquisition, right? And they were concentrated in particular business like funeral printing, office products, etc. So basically the idea was to combine smaller companies into bigger ones, right? And then by combining those smaller firms, they can enjoy economies of scale, right? And also they can have access to national market. But the backdrop is that these acquisitions were mainly fueled up by irrational exuberance or very high valuations in the stock market in the late 1990s. Right? So because in the late 1990s, the internet stock and also the stock market in general were very highly valued. Right? There's the highest. These are there are periods of high stock market valuation. Right? That's why many acquirers catch on the wave and do those acquisitions. There's evidence to how about the performance, right? So there's evidence that managers pursue deals that had modest positive effects for shareholders. But the general conclusion is that many of these deals were value destroyed, right? Especially between 1998 and 2001, acquiring firm shareholders, they lost a shocking 240 billion, right? And then the bidder shareholder losses exceeded those of the target shareholders by 134. So you can see during this crazy period of high stock market valuation, many bad deals were done. So the question is, why were the losses in the fifth wave as large as they were? Right. So I mean, it seems that after the first three mergers, acquirers should become more rational, right? But it's not, right? The reason is that managers, they were initially restrained, but because of the high stock valuation that reoccurred in late 1990s, they become crazy again. They become irrational again, right? So you can see the PE ratio in the late 1990s, right? Becomes really high, right? Now, and then after 2000, after late 2000, it goes down, right? So this is when the internet bubble busted, right? The worst merger that is done during that period, right, is the merger between AOL and so AOL is American Online and Time Warner, right? It was called the worst merger in history because the merger acquisition, this merger initially cost 165 billion. It was the biggest merger in history, right? But unfortunately, after the deal was announced, the dot-com bubble busted, internet stocks goes down, right? So then, and also increased availability of the high-speed internet cut deeply into AOL's dial revenue, right? So that makes the acquisition really, really bad, right? And then after 10 years, the AOL CEO Steve Case quoted that what were the main reasons that this deal failed, right? It was because this deal was driven by wrong cultures and short-term thinking. So basically the idea is that AOL and Time Warner, at that time, the people of AOL and the people at Time Warner, they were very, very different people. They have very different thinking about the businesses, right? And also they don't like each other. That's why in the post-integration process, both AOL and also Time Warner, right? They hate each other. So that's why it makes the post-merger integration very, very difficult. Yeah. The other reason is short-term thinking, right? Because at that time, the internet stocks were at the peak, right? So they were thinking about taking advantage of the internet stock valuation and then do the deal, right? That's a short-term thinking. So 9 years later, Time Warner actually spun off AOL, right? So at that time, it was only worth 3.4 billion. Now you can see from 165 to 3.5 billion, right? Which this was the biggest loss in the post-merger integration ever. That's why it was called the worst merger in history. Right? Finally, sixth wave, right? So the sixth wave was basically because of the low interest environment, right? So remember what happened in 2009, right? In 2009, there was the 9/11 terrorist attack, right? To respond to this terrorist attack, Federal Reserve set a very low interest rate, and they extended these low interest rates in periods after the 9/11 terrorist attack. Yeah? So then this low interest rate environment gave rise to the private equity businesses, right? And then leverage buyouts, they become popular again, right? Basically, private equity, they use the debt, which was really very inexpensive at that time, to buy the company, take the public company private, and then wait for the market to rise, and then push the values up, and then sell them at a profit. Yeah? Right now, we can look at the valuation of the P/E ratio at that time. Right? So at that time, after the 2001 terrorist attack, the P/E ratio goes up, right? And then when the merger ended in 2007, right before the financial crisis, right, it was increasing all the time, right? Now after that time, there's a financial crisis, so everything broke down, right? Okay, this is pretty much the long introduction, right? So we will hold a live session after you guys have learned these things, right? And let me know if you have any question on the class time, right? So that will be it. Thanks.